Hey everybody, a lot has happened with one of my larger holdings, Boston Omaha. Ticker symbol is BOC. It's been an eventful couple of months for them, and this is a stock that is usually not very eventful. So let's dive into this. Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from my sponsor, The Motley Fool. The best way to support this work we're doing on YouTube, again, that is fool.com/Frankel. So I'm just going to kind of give you an overview of what's been going on lately with Boston Omaha. So let's start when we got their annual report, which came out a couple months ago. So generally speaking, the three core businesses that they invest in are doing okay. That's the billboard advertising, that's the insurance business, and that's the broadband, the fiber internet business. All those are doing okay. They're cash flow positive. They're they're growing those. The gross margins on those three businesses are very acceptable. So I don't have a problem with that. The first big change that happened, and this came with the annual report, is they kind of threw investors a curveball and announced that they were going to wind down Boston Omaha Asset Management, which for the past 2 years or so has been what management has been hyping up as their big opportunity. Yes, they were in the they were saying the broadband internet was a big opportunity, but the asset management business was supposed to be what takes it to the next level. So the original vision, if you weren't too familiar with it or don't remember, they started this with a built for rent housing fund where they were going to try to raise about $150 million of third party capital. They were going to invest alongside with their investors and use that to go after the opportunities that they saw in built for rent housing. Hopefully, generate some fee income as the investments did well, kind of like what a Brookfield does in a way. And then after that, they had mentioned that they see a bigger opportunity in broadband than they have the money to do, and we're going to raise another $400 to $500 million of third party capital for fiber, which sounds great. It's kind of a it's skewed in their favor. It skews the odds in their favor to invest other people's money. If it does well, they get 10-20% of whatever they make their investors. If it doesn't do well, then they'll have a tough time raising money in the future, but they're not out anything. So the problem was they they failed to raise capital. Period. For whether it was their fault or not, it could have just been, the market conditions did deteriorate. They ran out of opportunities and built for rent. They weren't able to raise money at an acceptable interest rate or an acceptable yield or valuation or whatever. But for whatever reason, they couldn't do it. They decided to wind down Boston Omaha Asset Management, essentially killing the possibility of all that third party fee income and things like that. They didn't really explain it at the time, just said that we're not going to do this anymore. And that was that. So fast forward a few months, they had announced that they were going to do on a virtual annual meeting this year, which is kind of a departure from the in-person meetings they've had in the past. I was at the one last year in 2023. And about a week before the meeting was supposed to happen, they abruptly canceled it. And they said at the time, due to shareholder input, that they wanted to go back to an in-person meeting. And fine, but don't do it a week before you're supposed to have the actual meeting. That was kind of a red flag because it's something that wouldn't really fly from any publicly traded company. It would be seen as a red flag from anyone else. So I'm just giving them the same treatment that anyone else would get. And then we eventually found out that that wasn't the reason. Co-CEO Alex Rozek, who is the one that, if you've ever heard the Berkshire connection, he was the one that's Warren Buffett's grandnephew, is departing from the company. He's gone now. Decided to leave. He was, the more entrepreneurial of the two, I guess you would say. He was the one driving for more, variety and cash flow and things like that. Whereas Adam Peterson, who is staying as CEO and actually has a bigger stake in the company, is the more of the compounding mindset. Wants to just keep the three businesses, really just reinvest into them over and over and over, and really focus on efficiency of them. So they said that given all that they wanted to now in Adam Peterson's annual letter that they want to shift more to They feel like they owe it to investors to have an in-person meeting and kind of face the questions and things like that. So I'll just say a couple more things, and then I'll kick it over to Tyler. I could rant about Boston Omaha's recent issues for hours. Um, there's a solid argument to be made that Alex Rosick departing the company is a good thing. For one thing, I mean, it's bad news. Let's be perfectly clear, but it could end up being a net positive in the sense that one CEO is more financially efficient. You're only paying one. You're only paying bonuses to one. You don't need to have two people agree to get anything done. I honestly don't think Berkshire Hathaway itself would have worked as well as it did if Warren Buffett and Charlie Munger were co-CEOs and had to agree on everything before anything happened. It's just not an efficient structure after you get to a certain point. So I get it. It's kind of a red flag that he left right as Boston Omaha Asset Management kind of imploded. Just the two of those happening together is really a red flag. Executive compensation is another big issue. They paid massive bonuses to both co-CEOs in 2022 when the meme stock craze shot everything up in 2021, including Boston Omaha. They had set up a bonus structure, and I know Tyler can help me with this because he doesn't like excessive compensation any more than I do. They had a capped bonus over a 15-year period that would be paid based on performance. And the idea was that over the 15 years, they would incrementally earn this bonus because the stock went all meme stockish in 2021. They earned all 15 years bonus in 1 year, and it was paid to both of them. And now Alex Rosick took it and is out the door with all that money. So they did little to address that in Adam Peterson's letter, essentially saying, well, we didn't mean for that to happen, but it did, so let's move on. I feel like shareholders deserve an apology for that because it was, I want to, it's very, it's a unreasonable level of compensation they got, especially since the IPO, they've generated a 4% annualized return for investors. And they just paid a big premium to buy back Alex Rosick's controlling shares. They have those super voting Class B shares. They paid a $9 million premium to to get those back. I'll stop ranting. Tyler, what do you think?
For as long as you and some other people that you and I kind of chop it up with from time to time have talked about Boston Omaha, I feel like there's been a little bit of a myth making around what they were. Like you said, kind of had that Buffett connection. There was always terms kind of thrown out as like, baby Berkshire, this idea of like buying in, the bones of the idea of like, we're going to buy boring businesses like an insurance company and use the float to buy fiber optic cable and billboards. Not slow, boring, should be reliable businesses that just are going to throw off cash, right? The challenge that I've always seemed to come across when I've looked at Boston Omaha is kind of the myth making idea of those being good ideas versus the actual execution of those. And so for the past 10 years, I'm pulling up their financials right now. Over the past 10 years, Boston Omaha has not had a positive return on capital. So I know like with the adjustments and all those things, and they'll say they're free cash flow positive, but they actually haven't had a positive return on capital. And this is kind of where it like that narrative or the myth making really starts to like run incongruent with what we're seeing. Because if Berkshire Hathaway, Warren Buffett, had negative returns on capital for his first 10 years, he would be out of business. This was a guy who was putting up like 30, 40, 50% returns in his first 10 years. And so that really kind of throws that whole argument of the baby Buffett out the window. And the other thing that I have yet to hear when it comes to Boston Omaha, it's like, yes, they've acquired good businesses, right? Fiber, insurance, and billboards. That all makes sense, right? Like in theory, that makes sense. They should be stable businesses. They should grow cash flows. You don't have to put a lot of money to reinvest into them, except for maybe fiber. You can allocate capital for growth, but the actual maintenance capital required to keep those businesses spinning isn't a lot, right? Which is fine. But one of the things that I learned I've learned a lot, especially in like oil and gas infrastructure, and a lot of other heavy cyclical industrial businesses, is when it comes to slow growth businesses like this, price matters so much to your return. Because if you buy these things for slightly more return, a slightly higher, like let's call it, instead of 8 times EBITDA, you buy it for 9 or 10. That can have monumental implications on your returns. Because if you're a 2% growing business and you pay an extra 2 turns of EBITDA for your business, all of a sudden that adds at least 2 years onto your payback period. And so it's things like this intense focus on actual valuation. And from all of the, looking through their acquisition store press releases and all that stuff, I have yet to see a lot of discussion on what they actually paid for these things and what kind of expected return you got for them. And when we talk about these kind of businesses, that should be like bullet number one at the top of the list. Management sometimes in other companies will say, well, these were need to have assets or something like that, or we think we can grow it a little bit more, so it was worth paying up. That's all nonsense. It barely ever works when a company talks about it like this, and it does seem like the proof is in the pudding. Like I said, 10 years and we have yet to see a positive return on capital. Because if you overpay and you have to finance things with debt or some other cost of capital, that's going to erode at your returns. And that's just how it seems like that's what's happened at Boston Omaha. And because of that, I don't really believe the story. And I would be, I always reserve the right to be wrong. And I do hope for people who are investors in Boston Omaha that I'm wrong. But it just seems like there's been so much poor performance from its capital allocation over the past couple of years. I don't know. Maybe that was an influence of Rozek, and that will not be an issue going forward. I don't know. Maybe, but it's going to take a lot to kind of start giving management the benefit of the doubt here.
Yeah, and I'm kind of in the same boat. I'm going to give it a little while. Like I said, I own a bunch of the stock. I I want to see margins improving. There's no reason from those three businesses, billboards, insurance, and broadband, that you shouldn't be bottom line profitable. And they're not. And you're right. The reason you just kind of mentioned, maybe it was because they were trying to do too many things and build out an asset management business and focus on all this, that, and the other, instead of just compounding and focusing on efficiency of its core businesses, which would have been the more Buffett-like thing to do from the beginning. And that's kind of what it was created to do. But they kind of, I feel like around 2020, maybe a little bit before, kind of lost sight of just the compounding aspect of the business. And it was just kind of like, well, we can create a new revenue stream over here with built for rent. We can create a new one over here. We can buy a minority stake of this. We can start a SPAC, which they got very lucky on that. Honestly, the SPAC worked out in their favor. Other than Sky Harbor, I can't tell you maybe one SPAC from that era out of hundreds that is over the $10 initial price. So not lucky. I mean, they did their research, and it's a great company and all that, but not all SPACs worked out. But point being that maybe the focus on the three core businesses is what we need. So that's why I'm giving it a little while to kind of marinate and see how it see if the numbers start trending in the right direction the next few quarters. And that's kind of what I'm looking for. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.